You're tuned in to Agriculture Today, and we start our Wednesday show talking with K-State and Washburn Law Professor Roger McEowen. Roger, thanks for joining us today.
Well, thanks for having me, Shelby. Good to be here.
Roger, talking through a few topics from your recent blog article, and one of the topics in that article involves emergency relief program, but first, it used to go by a different name.
Yeah, it was the Wildfire and Hurricane Indemnity Program, or WHIP. And it was renamed to ERP, the Emergency Relief Program, and that was done a few years ago. But the amount of farm income is key to maximizing your ERP payments. It's a farm program payment. And so the question that was created here was how USDA would treat gain from equipment sales in light of a change made by the Tax Cuts and Jobs Act, which took effect in 2018. And that problem is still there. It's still a big deal today because USDA's FSA has dug in its heels on this issue.
And so what issues is this for farmers and ranchers who are maybe wanting to utilize ERP?
Well, if we back up and we talk about what the ERP is, it makes payments to a producer that has a crop eligible for crop insurance that has been subjected to a qualifying disaster and has received crop insurance or prevented planting payments in either 20 or 21. So we're talking about those years. And then later, the USDA announced the deadline for commodity and specialty crop producers to apply for ERP for 22 natural disaster losses was August 14 of this year, so August 14 of 2024. Now, the payment limit on your ERP payments is the general $125,000 payment limit, which applies to most farm programs. But if more than 75% of your average AGI comes from farming activities, then the normally applicable $900,000 AGI limit to be even eligible to get payments drops out, and the payment limit goes to $900,000 for specialty crops and $250,000 for all other crops. So that 125 then moves significantly up. $900,000 is what you could collect for specialty crops, and $250,000. It's essentially doubled for the crops we would see in Kansas and in this part of the U.S.
When we're thinking about farm income then for this program, what gets counted for it?
Well, what FSA has always looked at is the net Schedule F income and pass-through income from farming activities and wages from a farming activity. And also counts, what would count would be income from packing, storing, processing, transporting, and shedding of farm products. So a lot of your fruits and vegetables would fit in that category. But USDA says that their position has been that farm equipment sale gains only count if the farm income exceeds 2/3 of overall AGI. Well, that interpretation prevents many farmers from qualifying for increased payments. You can get $125,000, but you're stuck at that payment limit. You're not going to get $250,000. You're not going to get $900,000. Now, the House, early in 24, passed a tax bill that fixed the problem and would treat equipment gains as farm income. And that said that if we had trade-in of farm equipment that's reported on Form 4797, which is where we report that now, given TCJA and the elimination of 1031 exchange rules for anything other than real estate. So we go to the Form 4797, it wipes out self-employment tax, but we're not going to the Schedule F with it, which is what FSA stays fixed on. What's your net farm income number on the Schedule F? And the House bill in the spring said, well, FSA, you're supposed to count Form 4797 equipment gains. And a lot of farmers, in some years, that's all the positive income they show is from equipment trade. So it's a big issue. Now, that legislation got bogged down. The Senate didn't get through the Congress, so we're still stuck with this same problem. So maybe a change in administration leads to a new tax bill that changes this, and new people in USDA that recognizes, this is an issue that really is inequitable and needs to be fixed.
And Roger, another topic within this blog article involves what happens when a grain elevator fails.
Well, I bring this up because times are tough in a lot of agriculture. Incomes are down, and grain elevators tend to be highly leveraged. Co-ops, in particular, tend to be highly leveraged. So when their farmer clients are struggling financially, that can mean that we're going to have a ripple effect, and that's going to affect the local grain elevator too. So what I'm writing about here is, what if that grain elevator fails? And we had a rash of these about 25 years ago with abuses concerning hedge-to-arrive contracts. Now, we don't have that problem right now. This is more general economic issues in agriculture that could lead to an elevator failure. The first thing to understand is when an elevator files bankruptcy, a farmer that has grain stored there is not a creditor of the elevator. It's a bailment relationship. I put my grain in the elevator, and I can't, for example, go to the elevator and say, I want to visit my grain. There's no compartment for my grain. It's commingled with everybody else's grain that is stored in the elevator. That's a bailment relationship. We own all that grain in common. And so the warehouseman, the elevator, is then severally liable to each of us that have grain that's stored in that commingled fashion in the elevator. So if there isn't a grain shortage when the elevator fails, in other words, they've got enough grain in the elevator at the time they failed to pay out everybody that has a receipt, a scale ticket, or a warehouse receipt, then we're okay. But often, I can go get my grain in that instance, but often there is a shortage. So when there is a shortage, in other words, they don't have enough grain in storage to pay everybody that has a scale ticket or a warehouse receipt the amount that they're entitled to that they put in the elevator, that's usually the case. And so your claims exceed the amount in there. So in that situation, if I've got a negotiated receipt or a scale ticket, I've got a warehouse or receipt or scale ticket that says I've got 100,000 bushels of grain in this elevator, and somebody else has 200,000 and 300,000, but there's only 400,000 total in the elevator, then what do? Well, in that situation, then we share pro rata in that remaining grain. And so there's a pro rata distribution. I'm going to get a portion of my total amount back. Somebody else is going to get a portion of theirs back, so forth and so on. Now, I'll likely not be made whole. Then, in that instance, I become a general unsecured creditor of the elevator to the extent of the shortfall. Now, I'm unsecured. So they're going to pay their secured creditors first before they get to me. And the state has an indemnity fund, but that's not going to go very far either. So I'm probably going to come up short in that situation.
Is there anything growers can do to protect themselves on the beginning end of that?
Well, you always want to check out what the financial status of your elevator is. And, you're going to get a snapshot in time, and you're going to see a balance sheet and so forth. That doesn't tell you a whole lot. Word of mouth is pretty good. You can try to do a UCC 1 security interest, but the elevator's not going to go for that. So your remedies are not really too much in this situation. Just be aware of what position you're going to be in.
And Roger also wanted to touch on the topic of speculation and hedging when it comes to taxes, and what's the difference between hedging and speculation?
Well, if I'm truly hedging in the commodities market, that means I'm trying to offset price risk in actual commodities that I raise. That's what a hedge is. If I'm speculating, then I'm taking a position in commodities that I don't raise. Okay, so that has a tax effect to it. So if I lose money on a hedge because I engaged in that in accordance with commodities that I actually own and actually produce in my business, then any loss is a fully deductible ordinary loss. Okay? If I'm speculating, my gains are capital, but my losses are capital. So my losses are then capital losses that are severely limited in deductibility every year, up to $3,000. I'm capped. And if I have a large loss, I may never fully deduct that. So a lot of farmers will say when they try to make the argument that when I lose money in the commodity futures market, I'm hedging, when it's actually speculation. They'd like to get an ordinary loss, which is fully deductible. And that's where the rub comes in, and that's what the IRS will try to pick at. So be careful if you have, say, multiple entities. You've got a crop entity and you've got a livestock entity, and your crop entity engages in futures transactions involving livestock. Well, that's speculation. You've got to have the right entity. You need to use the farm bank account, for example, instead of your individual account. It's those types of things that IRS will try to pick at.
So really important, losses change differently whether you're working in that commodity or if you're not.
Yeah, if I am trying to engage in a commodity future transaction to offset price risk in actual commodities that I raise, that's a hedge. And if I lose money, fully deductible.
And Roger, as we wrap up today's show, just wanting to make a mention of a class you are teaching here at K-State. If anyone's interested in maybe enrolling.
Well, this is taught through K-State Global. I will teach it live on campus every Tuesday and Thursday morning starting at 8:05 a.m. Central. But it is technically an online course, so we can have people from anywhere register for the course and take it. You can take it for credit or you can take it for non-credit as adult continuing education, and that'd be fine. I would encourage farmers to do that. I have farmers from all over the country in the past that have taken the course for non-credit. And people can drop myself an email or Dr. Featherstone, who's the department chair in Ag Econ. It can email him at afeather@kstate.edu or at ksu.edu, I should say. Mine, you can reach me at either my law school address or my K-State address and for further information.
Roger, I appreciate you taking the time to join us today.
Thank you, Shelby.
That was K-State and Washburn law professor Roger McEowen. I will link his blog article that talks about these topics in today's show notes on agtoday.net.